Sounds like an old record.
Yes.
It does, doesn't it? Are we starting with a rap or something?
It's 12:07. Michel, shall we start?
I would start.
I think so.
Yes. And
Okay.
I'm already recording. Okay.
Well, thank you very much, and welcome everyone to today's presentation, post-Brexit implications. Over the last few years, Brexit really has been a subject matter that something I would say that keeps on giving, and today's presentation is going to be really focusing on the post-Brexit implication, focusing on first the trade agreement that was signed not long ago, and of course the repercussions and the implementation of that trade agreement, and following also, of course, on the impact on the financial industry agreements that still need to be settled. First of all, a little housekeeping. Today's presentation will be recorded. I will ask you to all mute yourself. And if you want to, and the presentation will be shared on social media. Also want to welcome all of you who are from Luxembourg and the US, and we're doing this event together in collaboration with the AmCham and Elvinger Hoss and PwC. So thank you very much. And of course, I want to welcome Excellency Ambassador Gaston Strong to the presentation. Today's speakers have a great knowledge, and I thank all of them for sharing their knowledge on this subject. First, let me introduce all three of them. We have Mr. Luc Frieden, former Ministry of Finance of Luxembourg, currently partner at Elvinger Hoss and chairman of the Luxembourg Chamber of Commerce and chairman of the Luxembourg Bank. In addition, we have Mr. Andrew McDowell, a partner in PwC Strategic and Consulting Business. He was former vice president and member of the management committee of the European Investment Bank and former chief economic advisor to the Irish Prime Minister. Finally, Mr. Matt Moran, corporate finance partner at PwC in Luxembourg, and leading the firm's insurance and industry and Brexit task force. For 25 years, he had the experience in the M&A business, both as lead advisor and principal investor. Well, thank you all three of you for your participation. And dear Luc, I will ask you the first question. From your wonderful experience on all sides of or multiple sides of the political spectrum and your professional career, would you please give our audience an overview of Brexit and what's to come? So thank you very much, Luc.
Thank you, Michel, and good morning to everybody in the US and in Luxembourg. I think to better assess what this trade and cooperation agreement is in the context of Brexit, one is to look back a little bit at what happened. And I do think that what Brexit indeed represents is a major, historic, and unprecedented event in European integration history. You know, when I have been sitting, and I was sitting for 15 years as Minister of Justice and Minister of Finance in the European Council of Ministers, I saw a lot of countries that wanted to join the European Union. Still today, there are a number of countries in the Western Balkans, Ukraine, Turkey, at least parts of the population in those countries, who have the aspiration to join a bigger ensemble, which can better tackle the issues of climate, security, migration, and other topics that do not stop at the borders. And therefore, I think this is really something that when people look back at Brexit, they will consider this to be something abnormal, as it is the only time that somebody left the European Union, left the table where decisions for the future of the European continent are being taken. Now, to see what this means for the future, one should not forget that in the areas where there's a lot of international trade going on, London, Scotland, the majority of people voted against Brexit. 60% of the people in London voted against Brexit. And all these people have to live now with a new environment, which since the 1st of January is from a legal standpoint completely new, with a lot of bridges that have been cut from one day to another between London and the rest of the continent, in particular in financial services. It's rather difficult to leave the European Union, and the British have realized that. And that explains why we have been talking about Brexit for such a long time. Let us not forget that the referendum on Brexit happened in June 16, so almost 5 years ago. And it took 5 years to leave the European Union because it's extremely important for the companies and for the people to have a certain transition and to organize the future. And I think that was never told to the British people during the referendum. The other major political mistake that was done prior to the referendum, and which has its consequences still today, is that the British government and those who were in favor, the British government was against Brexit, but those who were in favor of Brexit, both sides did never say what exactly would happen if you leave the European Union. Will you stay in the single market? Will you be in a customs union? Will you be in a loose association such as Switzerland? Or will it be a customs organization like with Turkey? That has remained very unclear. And that explains why those who voted in favor of Brexit did not all necessarily vote for the same thing. They voted, in fact, for something which is probably impossible to realize. It's a little bit like making Britain great again, to use a terminology that was used elsewhere and that you know better in the US. It was a dream of taking back control of your own laws, of your borders, of your money. These were the words used by the Brexiteers. And the question is, can they take back the control about their laws, in particular in a very interconnected world where financial services are regulated not by one country, but by the international community, to speak only about financial services, but the same would be true and is true for international trade. Now, the fact that the UK left is not only from a political point of view a major event, it's also a major event from an economic point of view. Because let us not forget that the UK is the second largest economy on the European continent after Germany. So it's a huge loss for the European Union, but it's a much bigger loss for the UK, because obviously the European Union still has this huge market of 400 million people, whereas the UK will be stuck on the island where they are, and from one day to another, they do not have trade agreements anymore with the rest of the world, because trade agreements are negotiated by the European Union on behalf of their member states. And since the 1st of January, when the transition period ended, the UK is on its own and has to build new bridges. It lost the access to what we call the single European market, in which, as you know, there is free movement of people, of capital, of goods, and of services. And that disappeared on the 1st of January this year. Obviously, not everything disappeared. And that's why, and Michel spoke about this trade and cooperation agreement, which gives at least a partial answer to the question that we have now in the new relationship between the UK and the EU. I think the main point, if you would like to summarize the treaty, is that there's an absence of import tariffs and customs duties. And there's also an absence of quotas on the movement of goods between the UK and the EU. but it's an agreement that is mainly focused on goods, and there is much less on services, which, by the way, is usually like that in free trade agreements. But what is amazing is that it has almost nothing on financial services. So despite the fact that the media said, and in December, we are very happy there is a deal, that deal is limited to goods, and for financial services, with a few minor exceptions, it's a hard Brexit. So in other words, those financial companies in the UK that used to have a license in the UK that gave them the passport, as we call it, to market their services, to sell their goods and services, their products all over the European continent, from one day to another, that link was cut. And so in the future, such companies need to comply with local requirements, need to apply for 27 licenses in the various member states, and we will probably come back in the panel later on to that. There are possibilities, but they are outside this treaty, for the EU unilaterally to grant certain rights to the UK in the matter of financial services, the so-called equivalence procedure. But today, at the moment where we speak, no such equivalence has been granted. So this is really a major event that took place. And in this free trade agreement, in the trade and cooperation agreement, there was an annex, there was a declaration, a joint declaration on financial services that said in the coming months, we will negotiate a kind of memorandum of understanding on how to deal with financial services. There has been some progress on that, but that memorandum has not yet been finally concluded or signed. And it will anyway mainly establish a kind of a joint EU-UK financial regulatory forum where there will be dialogue, but it's quite different from what we were used to have until now. So in short, it's a major event. For financial services, even more, because there is a clear cut since the 1st of January on all the bridges that were there under EU legislation between London and the rest of the continent. The UK is now, from a European perspective, a third country, in the same way than the US is, than Japan is, and others. The UK is now much less influential when it comes to drafting cross-border financial services legislation in Europe. And I can tell you, for having sat at the ECOFIN Council for many years, that the UK and the Chancellor of the Exchequers of the UK, they were extremely tough but brilliant negotiators. So they got out a lot what they wanted in that legislation. That will be passé, which is also regrettable for Luxembourg, because Luxembourg, the UK, and Ireland were actually the only three countries on many issues that had a common vision for cross-border financial services, and that alliance will, of course, now not be around the table of the Council of Ministers anymore. And I think for international financial services, that's not good. The big question will be, how much will the UK diverge from EU legislation in goods, in services, in financial services in the years to come? They said, and I reminded you of that at the beginning, we want to take control of our own laws. So how much will they use that? And that is a balancing act for the UK. The further they diverge, the less likely it is for the EU to grant them access rights to their single market. So it's one thing to say we want to be a world power again, but that requires that they have alternatives to the EU market. And I think there will be little alternatives to the EU market for British companies, and especially financial services companies, because the EU is and remains the main trading partner of the United Kingdom. And even if they manage to get free trade agreements with the US, Japan, China, that will take time, and that will never replace the huge European EU market. I think it will be much more complex for companies in the future to do business. Obviously, you can be happy outside the European Union. You can do business with the European Union without being part of it, but this all needs to be organized, and a lot of companies indeed prepared well for this, but maybe not all of them yet. It's a good time to be a lawyer, I can tell you, and a consultant, because this obviously makes the life of the companies extremely complex. It also makes the life of the people complex, because free movement of people meant that if a European wanted to work in London or vice versa, he didn't need to have any working permit, he just moved there. And so this is not possible anymore. So life of companies and people, as I said, has become much more complex. If I want to conclude my introductory remarks with something positive, I would say that's the title of the agreement. It's called a Trade and Cooperation Agreement. So at least there's the spirit of cooperation. And I think the good thing was that a deal happened. A deal was in the very last minute concluded in December last year, because the spirit of cooperation, I think, lays the ground for further discussions between the EU and the UK. The surprising point is that that trade agreement has not yet been ratified by the European Parliament. It was supposed to be ratified already at the beginning of the year. It entered provisionally into force, which I, from a legal point of view and international law point of view, find rather surprising for such an important agreement, that it has still not been ratified by the European Parliament. But I understand that that might happen at the end of April. But at least I think we have an agreement, and a lot of work still needs to be done now in the coming months and years for governments, and of course for the companies and the people to, yes, to live in this new world with the UK outside of Europe, of the European Union, and the rest of the 27s inside. It is, I think, retrospect, something regrettable that happened, but we have to live with it, and it's our role as Chamber of Commerce, as companies, to make the best out of it. It will not be easy, but I think we are there to help companies to organize themselves in this new environment. Well, back to you, Michel.
Thank you very much, Luc, for your introduction. You obviously have spent a lot of time on the political front, and also now on your consulting front, and learned a lot of lessons from Brexit. And you probably remember when we had breakfast just after the vote. I think that was back in September of that year, which was, as you said, 2015. And we discussed how long are the repercussions from the Brexit going to be? Is it going to take 25 years to absorb, or 100 years? And I think, as you well explain, it's going to take a long time to absorb it, if it ever will, like the shift when Elizabeth I was queen. So I think we'll be able to measure that. Thank you. Now, Andrew, from your front, would you like to share some of your knowledge from your expertise and from your point of view on what Luc elaborated on?
Well, thank you, Michel, and thank you to the Luxembourg American Chamber of Commerce for the invitation to speak today. And it's a great honor to follow Luc and to join Matt.
I forgot one thing, Andrew. Let me interrupt you just 1 second. I just want to remind the audience that if they have a question, they can send it by through the chat, and we'll take the question and answers at the end. So, Andrew, back to you.
And Michel, I may be so rude to interject. Just, I see my good friend Jonathan Hewitt not on mute there, and we hear it could be the phone in the pocket, or we hear that bit of disturbance.
All right, thank you.
Well, listen, really, I suppose I'm just going to pick up on a few points that Luc has covered already, but maybe to add my own perspective. I mean, the first point I suppose to make is at least there is an agreement. And I think this is the point Luc is also making, you know, when he finished on a positive note, is, it was quite possible that there wouldn't have been an agreement between, on Brexit between the UK and the European Union. Indeed, as you know, they left it till the very last minute. UK formally left the EU last February, but gave itself 10 months to negotiate a new trade arrangement with the EU before it reverted back to WTO trade terms, which would have involved the imposition of significant tariffs and quotas on goods trade between the EU and the European Union, which would have been devastating for large parts of the European economy, and particularly agriculture, but also manufacturing supply chains, the auto sector, and so on. So indeed, it is good news that even a narrow agreement was reached. But there is too, after a kind of initial surge of relief, I suppose, in the weeks that followed the agreement, I think there has been a dawning realization, as Luc has touched upon, that this is not going to be the same as it was in the past, that the relationship is going to be fundamentally different. I think even the little things are becoming obvious, like, it's the difficulty of getting an Amazon delivery from the UK now to Luxembourg, for example. You've got to pay a €25 customs handling fee when they present it to you at the door. But I think there's two more fundamental challenges and structural weaknesses in the agreement that are becoming apparent. The first is Ireland, in fact, and this is something obviously Matt may touch on as well. But the Northern Ireland Protocol and Ireland, in some ways, is the Achilles heel still of the EU-UK agreement. What is the Northern Ireland Protocol? Well, the Northern Ireland Protocol was actually part of the exit agreement of the UK from the European Union, and it's basically, without going into a terrible amount of detail, it's a mechanism that avoids the requirement to recreate an economic border on the island of Ireland between the Republic of Ireland, which remains inside the European Union and its single market, and Northern Ireland, which leaves the EU with the rest of the UK. Now, all sides to the negotiations, the UK, Dublin, London, and Brussels, everybody recognized that the recreation of an economic border on the island of Ireland would be hugely risky in political terms and in security terms, given the history of violence in that part of Europe, and given the 30 years of efforts that have gone into creating a peace agreement. But it's hugely complex, this protocol. It basically means that even though Northern Ireland de jure, leaves the single market and the customs union of the European Union, de facto, it stays inside, particularly for goods trade. And it basically means that there's going to be customs checks and technical checks on the importation of goods from the UK into Northern Ireland, even though Northern Ireland remains part of the UK, so as those checks do not have to take place on the land border between Northern Ireland and the Republic of Ireland. So effectively, there's a sea border now down the middle of the Irish Sea. Now, that has created huge political complexities, particularly in Northern Ireland, and it's not clear, to be quite frank, that there is the political will to make this very technically complex agreement work. Indeed, because of disruptions to trade between Northern Ireland and the rest of the UK shortly after the agreement came into force, the UK, in fact, earlier this month decided to unilaterally suspend parts of the Northern Ireland Protocol and the Brexit and the exit agreement. In response, the EU has already started taking legal action against the United Kingdom and is threatening, if that legal action reaches a logical conclusion and if it wins its case in the European Court of Justice, it could in theory start to impose tariffs on UK trade. Also, the European Parliament has actually postponed ratification of the entire agreement because it's saying the UK is no longer honoring its obligations. So it's just to mention that I think, even before we look beyond the UK Trade and Cooperation, UK-EU Trade and Cooperation Agreement, is to recognize, in fact, even ratification of that agreement is now threatened by distrust on both sides over its implementation in Ireland. And just as a side note, actually, it'll be interesting to see the impact of a new US administration and President Biden on this issue, because President Biden has a very personal, emotional attachment to the Northern Ireland peace process, given his ancestry. And indeed, a lot of members of the US Congress on both sides of the aisle have said they will not even consider a UK-US trade agreement if Brexit threatens to cause the reimposition of an economic border on the island of Ireland. But the second big challenge facing the agreement is exactly what Luc has mentioned, which is the narrowness of its scope. As he has mentioned, this is just mainly a goods agreement. It's an agreement not to impose tariffs or quotas on goods trade, with a few references to other areas. But the biggest, obviously, gaping hole in the agreement was financial services. And by one count, the agreement actually just contained less than 0.5% of the 1,300 pages in the agreement was referring to financial services. And one of the big questions a lot of people ask is, why did the UK, given it's a financial centre and a major exporter of financial services to the EU, why did it not insist on including financial services in the agreement, effectively trying to seek an agreement on equivalence before an agreement was reached? And there's probably two answers to that, which is, one was time. It just would have, from a UK political perspective, it would have taken too long. It would have been too complex. The negotiations would have dragged on longer than they had the political appetite for. Don't forget, Boris Johnson was elected to get Brexit done and to get it done quickly. So he just didn't have the time to widen the scope of the negotiation to include things like financial services. The second reason, and it's related, of course, is that the price they would have had to pay, the UK would have had to pay to include financial services, was simply too big. It would have, the EU as an importer of financial services would have looked to other areas of services where it's a net exporter, and would have insisted on including basically freedom of movement of people into the agreement if financial services was going to be included, because an awful lot of services that the EU exports to the UK involve freedom of movement. And that would have been intolerable to the UK for political reasons, because basically immigration was one of the reasons that drove the whole Brexit referendum in the first place. Just a few other words on financial services and I'll pause. I mean, the good news in some ways is that despite the inclusion of financial services in the agreement, the UK's exit from the single market was orderly, at least from a financial services perspective. There was no great market disruptions, and that mainly reflected, the work that had been done by financial market participants to prepare, but also, in fact, very good technical cooperation between supervisors, between the Bank of England and the ECB in particular. So there was a lot of work to make sure things didn't go badly wrong. There wasn't there was a Y2K fear around Brexit, that suddenly things would come to a halt on January the 1st, and that didn't happen. The bad news, obviously, is that there is just no visibility whatsoever for financial services as to where this goes from here. I mean, basically the situation is the EU will decide for itself. Now the financial services wasn't part of the wider trade agreement. The EU will decide for itself on a case-by-case basis what's in its interests in terms of allowing the UK market access. And contrary to some of the, if you like, misreporting that's going on in the UK, there is no ongoing bilateral negotiation on financial services, except what Luc has mentioned, which is this non-binding Memorandum of Understanding, which apparently is near finalization, but is really going to disappoint anybody hoping for specific commitments on market access. It's just that it's not going to be in this memorandum. I mean, effectively, the UK is now a third country for the European Union, and UK registered financial services firms have lost the right or the passport in EU parlance to offer their services into the EU market. They now have no better access to the EU market than financial services firms in Japan, in Singapore, and certainly in New York, and indeed in some segments of the financial sector. Firms in New York and other third countries have better access to the single market than British ones, and this is because of these so-called equivalence decisions that the European Commission has offered. third countries on a case-by-case basis. And this is where the European Commission decides that the regulatory framework in a third country is equivalent and is sufficient to allow a party based in that third country directly offer its services into the EU market. But these are completely at the discretion of the European Commission. It's not a negotiation. And unlike a single market passport, it can be removed at very short notice. And so far, the Commission has not granted the UK any segment-specific equivalence, except in a very time-limited way in the area of securities depositories until the middle of this year, and so for some clearing services until the middle of 2022. And it looks at the moment like Brussels does not appear in the mood to make either these limited equivalence offerings permanent or to offer anything new. And indeed, in most market segments, it looks like the Commission will simply refuse to offer equivalence to the UK. Now, the UK obviously argues that Europe is shooting itself in the foot. It's depriving itself of access to deep global euro and dollar liquidity pools that are, available out of London, and that this is just bad for the UK and bad for Europe, and it's a purely political decision. The EU retorts that basically it cannot rely on the actions of UK supervisors to protect EU interests in a financial crisis, particularly in the context where the UK has stated its intention to diverge from EU regulatory standards. But it's also true, if truth be told, that the EU's position partly reflects, a slightly more mercantile philosophy, sometimes grandly titled strategic autonomy, to use Brexit as an opportunity to build a stronger financial services sector in Europe and to bring the jobs and taxes that come with high value added financial services sectors. And it's no surprise, to hear that jobs have moved because a lot of services, have anticipated the requirement to move, but it's been fairly limited to date. By some estimates, about 7,000 jobs only have moved from the City of London to various EU financial centres. But this may accelerate given the lack of visibility and progress on equivalence or any type of formal agreement on financial services. The locations that are, bidding, are in the lead, if you like, to try and pull in business from London is obviously Amsterdam, Dublin, Frankfurt, Luxembourg, and Paris, with different specializations and different offerings. Obviously, Amsterdam is looking for trading activities. Dublin and Luxembourg are looking for asset management. Frankfurt is looking for investment banking, and Paris is looking for the whole lot, as the French always do. Final point. Will this accelerate? Just a personal perspective. I mean, there's been a trickle of movement so far. Will it accelerate? I think it probably will. I do believe Brexit is probably a high watermark for the share of financial services in the UK economy. I mean, don't forget, the city was the onshore financial centre for the entire single European market, as well as a competitive offshore centre for the rest of the world. Now the city is an onshore centre only for the UK, and it becomes an offshore centre for basically the rest of the world. I mean, this may not be the worst thing in the world, by the way, for the UK. It probably had too much financial services, and it may allow a little bit of rebalancing in the UK economy. Cheaper sterling, cheaper housing, a little bit of regional and sector rebalancing wouldn't be the worst thing in the world for the UK. For the EU, I think it's an interesting challenge. We could see a bit of fragmentation in the financial market, and I think the challenge for the EU is really not just to look at Brexit as a short-term opportunity, but really to work hard to complete its own banking union, capital markets union. These are only half-finished agendas that the EU needs to finish for itself if it really wants to build a strong financial market. And a final thought: if the EU doesn't get its own act together in building a stronger financial market, around banking union, capital markets union, perhaps the biggest winner of Brexit from a financial services perspective will not be Amsterdam or Frankfurt or Dublin or Luxembourg, but rather New York or Singapore.
Well, we shall see.
Thanks very much.
Yeah, well, thank you very much, Andrew, for your thorough review. And on to Matt. Matt, any impact, any solutions? I think that we have a lot of our members would like to find out more ways of how to make their way through the upcoming mazes, trade agreements. And so any solutions you can anticipate or any recommendations?
Well, thank you, Michelle. And again, thank you to the Lux American Chamber of Commerce and Your Excellency, Gaston Strunk. Well, to follow Luc Frieden and Andrew McDowell is a hard task. You know, they've already covered quite a lot. So over the next 2 hours, I hope to take you through some of the detail. No, I joke, of course, but listen, so many topics raised by Andrew and Luc. Maybe to touch on a few, you know, what's the future of London? You know, it has been often referred to as Singapore on Thames. So London trying to reposition itself as a global centre to make up for its lack of access to Europe. And I think Andrew's point is very relevant here. Whilst there have been short-term wins in the cities, and Andrew mentioned asset management for Luxembourg, but of course insurance has been a huge boom in Luxembourg as a result of Brexit, where we've had you know, close to 20 businesses now established on a global level. And maybe we'll talk a little bit more about why that happened in a minute. But you know, there is definitely a risk about Europe's ability, the EU's ability to service the need and its financing need, which has benefited from the connection with London historically. So that is definitely a concern, and indeed was raised by Mairead McGuinness, our new EU Financial Services Commissioner, who mimicked the phrase of Boris Johnson by saying, you know, we need to make sure that we take back control of the financial services agenda in the EU. So that is definitely a relevant point. What have you seen amongst the financial services community? I think really when Brexit happened, companies could not wait for the political uncertainty to be solved. So as a result, what you've seen is, you know, most major businesses, most US businesses, Asian businesses, and UK businesses that needed access to the European market have established regulated presences in selected countries. So they have, rather than wait for the outcome, as Luc said and Andrew referred to, the fact that the financial services hasn't formed part of the trade agreement to date, and I'll come back to that in terms of what's just recently been leaked in terms of the Memorandum of Understanding. But companies have therefore established presences and in order to maintain their access. And the Luxembourg solution, I think, was very interesting. I remember visiting London the week after Brexit and talking to a number of companies, but also talking to colleagues in the UK. And the way I described it was, you know, Luxembourg is the least worst option for you, because Luxembourg doesn't want to have 1,000 people from an insurance company land in the city. You know, the city cannot handle that today. But Luxembourg has a highly reputed regulatory regime. It's well known as a financial centre globally. It clearly punches well above its weight, and the potential to establish, you know, a compact entity in Luxembourg while still benefiting from using the services of perhaps the HQ in the UK or the regional, you know, previous headquarters in the UK was still feasible in many financial services situations. So that's what we've seen happen, and I think Luxembourg has done a good job amongst at state level and with Luxembourg for Finance and the operators, the players in the sector, to make sure that Luxembourg maintained this strong relationship with UK business. So it has always maintained that. Historically, Luxembourg has always been very open, and I think it played that card very well to try and, you know, give UK business a solution to operate here. Now, I think one question that arises for the future is, whilst you've seen companies establish in the EU, how much of the activities of those entities will ultimately have to transfer? And I detect a change that I believe is coming from the super regulators like EIOPA, like ESMA, like the EBA, which is influencing local regulators to ensure that the base of hiring for those entities servicing the EU market will more and more become in the EU. So I think you're going to see greater presence, greater substance over time. So those entities that have established across the various cities, you know, will inevitably move more of their activity. And I think the EU will push that, you know, if you're dealing with other EU countries, then that activity should happen within the EU and it should be resourced in the EU. So that's something that I expect to see as we roll out further over the next 12, 24, 36 months. Luc referred to equivalence, and I think it's very interesting. I might just share my screen for 1 second. Or maybe, sorry, I'm not able to do so. But if you look, what, you know, the UK has granted equivalence across a host of various financial services regulations, but the EU has not done so. And that agreement that was referred to by Andrew and Luc, in terms of the MOU, rather, so the Memorandum of Understanding regarding financial services, is due to be released in the coming days. Initially, it was intended to be released by the end of March, so by tonight. And I was chatting to some colleagues in the UK about that, and in anticipation of it coming out in the coming days, one of them wrote, you know, completion of the Financial Services Memorandum of Understanding, celebrate or commiserate. Because what seems to be put together, as referred to by Luc, is really quite light. It's a joint financial regulatory forum, and it's a forum that, you know, they've decided to meet twice a year, but the effectiveness of that forum is left unclear, I would say, and indeed the power of the forum, whether it is to recommend solutions or mainly to analyze issues, that is also unfair. Secondly, the MOU does not seem to provide, is not expected to provide a timetable for making regulatory equivalence determinations, nor even a firm intention to make them. So what is clear then is that, you know, companies more and more will have to firm up their substance on the ground in order to maintain activity in the EU. Maybe just to switch topics very briefly.
I think there's somebody, but Matt, I want to leave a little time for a question and answers, and we have a few more questions. So. I'm not sure who's Tony. Can you silence the person? Pereira?
Pereira?
Yes. Excusez-moi, on vous attend. On vous entend.
Qu'est-ce qui s'est passé? Et en fait, c'est juste parce que je crois que sur le NICE, il doit avoir.
Okay, then Brexit interference.
$1. Afrique en genre, ils ont dû faire une division nominale pour
Janet, can you do something here?
Tony, is there something on your side? You can mute participants, please.
You mute all.
Just send them.
I've sent him two. You may be able to mute him on your side, can you?
Mute all.
One more time with it. If I mute all, okay. Mute all. Will allow participants to unmute themselves. Michelle, you have to unmute yourself now, okay?
I did. All right. Thank you for the privilege. Okay. Let me move on. Thank you, Matt, for your comments. And I think the participant, our guests here, like to know these things a little more about maybe Luxembourg. And look, could you give us some indications of why you think that Luxembourg, or how Luxembourg fed, and why companies should go to Luxembourg, and or for that matter, if they should go to Amsterdam or Paris, if that suits them better? Because I think the Luxembourg government has tried not to be greedy or to take advantage of the Brexit and brag about relocation. I think they were relatively civilized on that front, not to take advantage of somebody mishaps or bad luck. So, Luc.
Yes, I think I can build on what Matt said when he explained why a number of companies from the UK moved to Luxembourg. First of all, many of them were already there, so they beefed up their operation that they have in Luxembourg. But I think the main reason is that Luxembourg has a much more international legal framework. A lot of other countries, their main market is the national market, whereas for Luxembourg, and I helped drafting many of those laws, we always knew that the Luxembourg-based companies, their market is Europe and the world. And therefore, this cross-border element is much more present in company law and in other laws that are important. The second aspect, I think, is the stability. And I think I saw, like others on this webinar, companies coming from abroad who were looking for establishing themselves in the European Union, and what they always appreciate was the stability. And by stability, I mean that you are pretty sure that the laws will not change in a substantial manner after or every year or very regularly. And I think this element of stability, of foreseeability, prévisibilité, I think is something that is extremely important. And third, I would, and goes a little bit hand in hand with what I said, is a rather business-friendly atmosphere. So the access to the authorities, be it the ministries, be it the supervisors, the insurance supervisor, the CSSF, the banking supervisor, security supervisor, they are very much hands-on. They understand the international business. The English language is accepted despite the fact that French is the official language. So all this is a certain business friendliness that helped attracting quite a number of companies. And not all jurisdictions in Europe can have those arguments on their side. There are rarely strikes. There is, all these disruptions that happen in other jurisdictions do not take place in Luxembourg. So it's a group of elements that I think were true in the past and that were true in the context of Brexit. And so therefore, I think we were not looking for these companies, but we were happy to welcome them. And I think they will expand their businesses out of Luxembourg in the years to come.
Thank you, Luc. Andrew, just in the idea of short answers. I know this is going to be a complex question, but keep it short because we're coming to the hour. How are different or other European EU countries courting different financial service companies? Are they? Can you give us some sort of like comparison?
Well, I mean, it's interesting. I think a little bit along the lines of what Matt and Luc have said. I mean, in some cities, the business is coming even though they're not courting it. So, I don't think in Amsterdam necessarily. They're aggressively competing for the business, but the trading platforms are tending to go to Amsterdam anyway. I think Paris and Frankfurt are competing very aggressively, and the biggest offering they can make is really around is partly around obviously the quality of supervision. Paris competed extremely aggressively to get the European Banking Authority to move to Paris, where it was when it was previously based in the UK. It also has obviously the ESMA, the European Securities Markets Authority. So again, being proximity to the regulatory authorities is one of the attractions. Obviously, Frankfurt offers proximity to the SSM, Single Supervisory Mechanism. And then finally, they're offering things like, international schools, and the other quality of life issues that are going to be important for people in the UK.
Well, thank you. Matt, to you, do you have any examples of ideally, let's say, one or two US companies that you know of who are relocating staff from the UK to Luxembourg or other places that you know of particularly? And then we will have see if I have some more questions from our audience. Want to leave a few minutes.
Yes, Michelle, there are multiple companies who have established and moved people to Luxembourg. AIG, one of the largest global insurers, USAA, another insurer, has also moved people here. And then you've had the likes of JP Morgan or Credit Suisse, which, as Luc said, already had bases here and have sought to bolster their people base and competency here in order to handle the post-Brexit situation. If I was just to add, when I met American businesses and international businesses, I think some elements of Luxembourg, firstly, the last financial crisis impacted some countries hugely, but Luxembourg relatively was less impacted. And I think that's a factor in terms of connection and accessibility to the regulator that has remained, where in certain jurisdictions which went through very difficult financial crisis, that became a more difficult environment to engage with regulators. And I think Luxembourg had that advantage. Secondly, its positioning in the heart of Europe. It's a founding member, as everyone know, of the European Union, and I can say it myself, and I could say it with personal experience, having run an insurance company here as an Anglophone, dealing with the CAA, which is one of the only three dedicated insurance regulators in Europe today. The rest have been combined in other countries. But, you could deal with ease with the regulators here because their multilingual capacity and their comfort in dealing with you through English or through German or through French was so strong. And so it wasn't something that had to be artificially created. It was already embedded, given the education system here and given the international mindset of the country itself.
Yeah.
And finally, I would just add is I think also Andrew mentioned, regulatory supervision. That's undoubtedly the case. We've seen some banks go to France and go to Paris, because France already supervises, some of the largest banks in Europe and globally, and therefore can handle and manage broker-dealer and capital market organizations. Mm-hmm. So, clearly SocGen or BNP are co-regulated out of Paris. And I think that was a factor as well. People looked at, where was, the deepest existing confidence and understanding of their businesses. And hence, the reason why you saw a lot of activity in private banking asset management and insurance here for similar reasons. You know, in Paris, you had, you know, real strong broker-dealer investment banking supervisory capabilities and the network and ecosystem around that sector that therefore made Paris attractive to that situation.
Thank you very much, Matt. Thank you all for your really insightful comments, and I'd like to go over to Paul Schonenberg of the AmCham to make the closing remarks. Of course, before that, I want to thank Luc, Matt, and Andrew, of course, for the comments, Tony and Janet for organizing. And so on to Paul.
I echo the comments that Michelle made, thanking our wonderful speakers tonight, and also welcoming Ambassador Strunk to go ahead and to join us. There's not any point in me saying any more about the presentation tonight. It was wonderful, as we always would expect from this quality of speakers. But the one thing that I would like to make another point on is how nice it is that we are maintaining this wonderful cross-Atlantic connection between us, between New York and Luxembourg. And if we think outside the box a little bit, I think it's important to remember that the United States is an enormous and huge market, which coincidentally happens to have enormous and huge investments in Luxembourg. And as we're moving forward out of this current economic crisis that we're going in, the opportunity to go ahead and strengthen ties between America and Luxembourg, I think can be significant for Luxembourg itself, and likewise can be perhaps set a good example for future enhanced cooperation with the new Biden administration and the EU to further strengthen ties between America and Europe, which I think are absolutely vital for the preservation of the democratic way of life that we want to have, for our business and cultural interests. And in that regard, I thank my friends in New York for being so cooperative and helpful to maintain these relations together. And I hope you all will continue to join us, because in addition to putting on great programs, we're trying to strengthen the bonds between America and Luxembourg, because we think they're good for this country and we think they're good for Europe. So stick with us as we continue on that journey as well. Thank you all very much for a wonderful evening. It's nice to see you all. And if you like what you saw tonight, tell your friends to join us next time. Thanks, Michelle.
Thank you very much. Thank you, Paul. And thank you all. Yeah, goodbye.
Thank you, everyone. Thank you, Paul.
Thank you, everybody. Bye-bye.